You are looking at a multifamily property that you want to buy and you want to make an offer. But first you have to figure out if you're paying a fair price. In this video, I'm going to walk you through 3 ways that you can compare your property to make sure you don't overpay. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about 3 ways you can compare your property to make sure you don't overpay. And method number 1 is the income approach. Now, I have done many videos on the income approach before, and I'll put a link tag right up here to make sure that you can watch the full video on that. But basically with commercial real estate, income producing real estate, we are actually buying the income produced by the real estate, not the real estate itself. The real estate is just the vehicle, and all commercial real estate is valued using the income approach. So it's really important for you to have a handle and understand how this works. So some questions to ask when you're using the income approach. Well, is this property trading at the market cap? And the market cap rate is basically the cap rate that most properties within that class, that type of property, are trading at in that specific market. So if the cap rate is more compressed than the others, so the cap rate's lower, which means you're paying more for each dollar of income produced, well, that might be a red flag, and that might prompt you to ask more questions about the property and dig deeper into it. Or is the cap rate a lot higher, which means you're paying less for the income, for each dollar of income produced by the property? In that case, you also want to ask yourself, well, why is this the case? Is the seller distressed? Are there other issues going on? The whole idea behind these 3 methods to comparing properties is to force yourself to ask questions, to dig deeper. So income approach, number 1. Number 2, cost per unit. So let's say we're looking at a 200 unit multifamily property, and there's 5 other examples, and those units or those properties are trading between 70 and 80 grand a unit, hypothetically speaking. And then the property we are looking at is trading around $95,000 a unit. Is this a red flag? Well, maybe, but because we've taken a look at cost per unit, this is prompting us again to dig deeper, ask questions, figure out why. We may figure out that this is well worth the money based on a number of factors, and we're willing to go forward with an offer and do the deal. But this may also raise the red flags, some red flags, and then we ask ourselves, is this really something that we want to do? Does this really fit our investing criteria? So again, cost per unit, and always look at comparable properties. So if you're looking at a Class B property, don't look at Class A because the cost per unit is going to be a whole lot higher, and then don't compare to Class C. So take a very honest look at the market, find good comparable properties that are very similar, so similar size, similar vintage, so age of the property, similar interior condition, similar exterior condition with similar amenities, and that's going to give you the best apples to apples comparison. Then you can use cost per unit. And number 3, cost per square foot. And one of the things we look at when we're talking about cost per square foot is replacement cost. Are we buying this property for less per square foot than it would take to build it from scratch? If so, that sounds like a pretty good opportunity because we can't replicate that property for that amount of money. We would have to pay more. But maybe it's the flip side around. It all depends on your market, on your investment criteria. But again, this is all about forcing ourselves to ask more questions, dig deeper, go beyond the veil, beyond the curtain, really get digging deep. And sometimes, depending on the type of deal or your market or the situation, you may put more weight on cost per unit rather than cap rate or using the income approach. Often with value add properties, people will lean more towards cost per unit rather than buying based on a cap rate or even cost per square foot. But again, it all depends. We want to use all 3 of these to give ourselves a good picture of what the property is like and what the comparable properties are like. We can't just go based on income approach, but we can't also just go based on square footage. We have to use a mix, and this is the art of underwriting, or really doing your due diligence before making an offer and really finding out if this is the right property for you, and then that will in turn decide on how you structure your business plan. So I hope this helped give you 3 ways that you can compare properties to make sure you don't overpay. And if you're interested in learning more about the deals I'm doing, head on over to callseth.com and set up a quick 20-minute phone call with me, and we can talk about your real estate goals. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think, and until next time, happy investing.